Hey, this is Jordan, and this video is being recorded on the evening of Tuesday, April 27th, 2021. Thank you for joining me. Please like, comment, and subscribe if you're watching this on YouTube. Okay, so what's worse than a stock market crash? Well, the answer is an inflationary bear market or an inflationary period. And this is a great chart here looking at, I think this is done by Meb Faber. He's on Twitter, has a lot of great historical charts and data like this. And in this chart, it shows the performance of the S&P 500, the 60/40 portfolio, and bonds. So the 60/40 portfolio, if you don't know, that's 60% stocks, 40% bonds. And so this is the inflation adjusted performance. Now, this doesn't include 1900 to 1920, which is also a bad period in inflationary bear market. So I think that I have a fairly high level of confidence that that was also a shitty period for the 60/40 portfolio, even though it probably didn't even exist back then. So the real focus here is on 1968 to 1982, which was actually worse than the 1929 to 1942 Great Depression period. And the reason why was look at bonds there at the bottom. Look at the lines I drew. Bonds went higher during the 30s. They performed well. And from the mid 60s to the early 80s, bonds did not perform well. So that's why if you're an investor, a conventional investor, you go the 60/40 route, stocks and bonds. The Great Depression was actually not worse than 1968 to 1982. And what's interesting now is, well, let me circle back for a second. Look at, if you even look at the S&P 500, and again, so this is real returns. This is inflation adjusted. You can see the S&P 500, it declined in real terms from like 1965 to 1982. Not by a lot, but by a little bit. Whereas, go back to 1930. If you go from 1930 to 1942, it's down a little bit. But if you go from 1930 to 1949, it was basically flat during that period. So, I mean, you rather would have wanted to own stocks, I think, during the inflationary period. However, it's there's not a big difference there between the two. But you can clearly see the 60/40 there is. I mean, the 60/40 from 29 to 42, that was basically flat, more or less. But from 68 to 1982, you lost money, clearly, with the 60/40. So, and what's interesting today, we could be entering into an inflationary period. And I mean, that's the real trigger. And also, if you look at expected returns for the 60/40 portfolio, I mean, right now or in the last year or two, if you find charts of those, I mean, it's among the worst in decades. So, what everything comes down to is, are we going to see inflation break out and be sticky and run? And in this chart, we have the CPI, that's inflation at the top. Then we have CAPE, the 10-year PE ratio, which is a great long-term valuation indicator. And then we have the stock market, the S&P 500. So first, I want you to look at the two vertical lines there. We have one in 1965 and then one in 1968. And look at the two arrows there. Now, you can see that in 1965, late 65, that's when the CPI broke out to about a 7-year high. And then 1968, that's when it broke out to a 17-year high. So that was both were significant. The one in 68 was obviously more significant. And if you look at the, the first breakout, that was right around when the CAPE peaked, when valuations peaked. That's when the Dow peaked in 1966. And if you look at gold stocks divided by the S&P 500 because the gold price was fixed. In real terms, gold stocks started outperforming the stock market again, I think, in 1964. So, yes, the S&P still went higher until the early 70s, but in real terms, it stopped performing when you had those breakouts in inflation. And if you go back to the peak in the Cape, that happened in 1966. That was a 36-year valuation peak at that time. That was extremely significant. And so when valuations get that extreme, that also portends to poor long-term returns moving forward. So now we're at the same point where the Cape is basically, it's like the second highest it's been since the late 90s and early 2000s. So that's not good for stocks. But the real key takeaway here is the CPI there in the top right corner. And look, the economic data is a lagging indicator, so we'll only see this after the fact. But that's a 30 or 35-year down trend line for inflation. Let's see if the CPI breaks out there, holds above it, gets to 3.5%, 4%. I mean, it's possible it could break out and then come back for a year or two like it did in 2008. So that's one scenario to keep in mind. But it's also possible it breaks out and it stays sticky around 3 or 4% and then continues to move higher over time. I mean, if that happens, then you have a repeat of late 60s and 70s. And again, I mean, going back to what I said, this is just look at what happens when you have an inflationary secular bear market. I mean, it's awful for stocks, but you can look at the S&P 500 and you wouldn't have felt that in the late 60s or even 1971 or 1972. You would have said, yeah, this is fine. The market made a new high. We have a little inflation, no big deal. It's at 4%, 4.5%. Yeah, it's not that high. No big deal. If we go down the inflation road, you're going to see these perma bulls from the financial industry. They're going to be saying the same thing over and over again, not realizing that they're losing purchasing power and that, they're in the early stages of an inflationary bear market. And you have to be in commodities and precious metals especially. So, if we're heading into this very bad period, higher inflation, I say if because no one can predict the future. We never know, but we assess probabilities and the like. But, if we do get that breakout in the S&P, not the S&P, of course not the S&P, I mean the CPI and inflation. If we get that breakout, you're probably going to see there in the bottom right corner, you're going to see that ratio, which I always talk about, gold breaking out against the S&P 500. That's going to explode out of that breakout. Gold's going to explode out of its cup and handle pattern. And that'll happen while the stock market is struggling. So, look, the big takeaway here is an inflationary bear market is worse than a crash. It's worse than, with respect to the stock market, you'll have to be a trader. But if you're a buy and holder over the long term, it's worse than a crash. It's a disaster. The 60-40 portfolio is going to be a disaster over the next decade. And on that happy note, that's why you got to be in precious metals. That's why you should consider subscribing to our premium service. Check out TheDailyGold.com. A lot of great free info there. Subscribe to this channel. Check out my premium service. Leave me a comment. Let me know what you think. Thank you for taking the time to watch this. I appreciate it. I look forward to doing another video update in the days and weeks ahead. Thank you.